Question 1. Which of the following annuity products provides a fixed payout amount that does not fluctuate based on market performance? A. Variable annuities. B. Indexed annuities. C. Fixed annuities. D. Immediate annuities. Answer: C. Fixed annuities. Explanation: a fixed annuity offers a guaranteed, predictable payout amount that remains consistent throughout the contract term regardless of market performance. This makes it a stable option for individuals seeking a reliable income stream during retirement. In contrast, variable annuities offer payouts that are based on the performance of underlying investments, meaning they can fluctuate. Indexed annuities are linked to the performance of a market index, and while they have the potential for higher returns than fixed annuities, their payouts are not fixed. Immediate annuities are a type of annuity where payments begin immediately, but they can either be fixed or variable in terms of payout depending on the type of annuity chosen. Question 2. Mr. Brown is considering purchasing an annuity. He is 65 years old, has $100,000 saved for retirement, and needs a guaranteed income stream for the rest of his life. Which type of annuity would most likely be the best fit for his needs? A. Immediate fixed annuity. B. Deferred variable annuity. C. Indexed annuity. D. Immediate variable annuity. Answer: A. Immediate fixed annuity. Explanation: Mr. Brown's primary concern is securing a guaranteed income stream for the rest of his life. The best option would be an immediate fixed annuity, which guarantees fixed periodic payments starting immediately and for life. This suits his goal of having predictable income in retirement. A deferred variable annuity, B, is not ideal as it would require a waiting period before payments begin and is subject to market risk, making it less predictable. An indexed annuity, C, links to market indices but does not offer the same guaranteed income stream as a fixed annuity. An immediate variable annuity, D, would provide income based on market performance, which introduces risk and uncertainty, not the security Mr. Brown is seeking. Question 3. Which of the following Iowa-specific regulations applies to the sale of annuities to ensure that the product is suitable for the client's needs? A. The Iowa Suitability and Annuity Transactions Act. B. The NAIC Annuity Suitability Model Regulation. C. The Iowa Insurance Code. D. The Federal Suitability Standards for Annuities. Answer: A. The Iowa Suitability and Annuity Transactions Act. Explanation: the Iowa Suitability and Annuity Transactions Act is a specific state regulation that mandates insurance producers to ensure that the annuity sold is suitable for the client's needs considering their age, financial situation, and retirement goals. It requires producers to conduct a suitability analysis before recommending an annuity, while the NAIC Annuity Suitability Model Regulation B provides national guidelines. It is not exclusive to Iowa and may not always align with state-specific laws. The Iowa Insurance Code C is a broad legal framework that governs all insurance activities in Iowa, but does not directly address annuity suitability. The federal suitability standards for annuities, D, are not applicable as annuity regulations are primarily state-based, not federal. Question 4. Which of the following annuity riders guarantees a minimum income amount, regardless of market performance? A. Guaranteed minimum income benefit, GMIB. B. Guaranteed minimum withdrawal benefit, DBC, a long-term care rider. D. Inflation protection rider. Answer: A. Guaranteed minimum income benefit, GMIB. Explanation: the Guaranteed Minimum Income Benefit, GMIB, guarantees a minimum income level regardless of market conditions. This is particularly valuable for individuals seeking a guaranteed income stream during retirement, ensuring they receive at least a minimum payout even if the underlying investments perform poorly. The Guaranteed Minimum Withdrawal Benefit, DBC, provides the right to withdraw a specified percentage of the account value, but it does not guarantee income for life like the GMIB. Long-term care riders, C, are designed to provide benefits if the annuitant needs long-term care, and inflation protection riders, D, adjust the payout based on inflation, but neither guarantees a minimum income. Question 5. Which of the following best describes the tax treatment of annuities during the accumulation phase? A. Contributions are tax-deferred and withdrawals are taxed as ordinary income. B. Contributions are taxed as ordinary income and withdrawals are tax-deferred. C. Both contributions and withdrawals are tax-deferred. D. Contributions and withdrawals are both taxed as ordinary income. Answer: A. Contributions are tax-deferred and withdrawals are taxed as ordinary income. Explanation: during the accumulation phase of an annuity, the contributions made to the annuity are tax-deferred, meaning the investor does not pay taxes on the funds as they grow. However, when withdrawals are made during the distribution phase, those withdrawals are taxed as ordinary income. This is one of the key benefits of annuities, as they allow for tax-deferred growth. In contrast, option B is incorrect because contributions are not taxed as income upfront in a tax-deferred annuity. Option C is incorrect because only withdrawals are taxed as income, not contributions. Option D is incorrect because annuity contributions are tax-deferred, not taxed immediately. Question 6. Which of the following is the primary difference between a fixed annuity and a variable annuity? A. Fixed annuities have no investment options, while variable annuities offer a range of investment choices. B. Variable annuities are guaranteed to provide the same payout, while fixed annuities can fluctuate. C. Fixed annuities offer higher growth potential than variable annuities. D. Variable annuities are primarily used for tax-deferred growth, while fixed annuities are not. Answer A. Fixed annuities have no investment options, while variable annuities offer a range of investment choices. Explanation: the key distinction between fixed and variable annuities lies in the investment options. Fixed annuities do not offer any investment choices for the policyholder. Instead, they provide a guaranteed fixed payout, typically based on a predetermined interest rate. Variable annuities B allow the policyholder to invest in various investment options, such as mutual funds, and the payout depends on the performance of these investments. This makes the payout from a variable annuity less predictable and subject to market risk. Option C is incorrect because variable annuities generally offer higher growth potential due to market exposure, whereas fixed annuities offer stability but low returns. Option D is also incorrect as both fixed and variable annuities provide tax-deferred growth. Question 7. Mr. Harris is 58 years old and wants to begin receiving income from his annuity immediately. Which annuity type would best suit his needs? A. Deferred fixed annuity. B. Immediate fixed annuity. C. Deferred variable annuity. D. Immediate variable annuity. Answer B. Immediate fixed annuity. Explanation: an immediate fixed annuity B is designed to start payouts immediately after the premium is paid. Since Mr. Harris is 58 and wants immediate income, this is the best option for him. A deferred fixed annuity A would not provide income until a future date, which does not meet his immediate needs. A deferred variable annuity C has a similar issue, as it would not begin payouts immediately and exposes Mr. Harris to market risk. An immediate variable annuity D would start payouts immediately but would not provide the fixed, guaranteed income Mr. Harris may be seeking. Question 8. What is the primary purpose of a 1035 exchange in annuities? A. To exchange a life insurance policy for an annuity without triggering taxes. B. To exchange one annuity for another without triggering taxes. C. To withdraw funds from an annuity without penalties. D. To transfer annuity funds between different tax-deferred accounts. Answer B. To exchange one annuity for another without triggering taxes. Explanation: a 1035 exchange B allows an individual to exchange an existing annuity for another annuity without incurring taxes on the transaction, as long as the exchange meets IRS guidelines. This is a tax-deferred exchange and does not result in immediate tax liability. Option A is incorrect because a 1035 exchange can also be used to transfer life insurance policies, but it is not limited to annuities and life insurance policies. Option C is incorrect because 1035 exchanges do not allow withdrawals without penalties. Option D is incorrect because 1035 exchanges involve the exchange of annuities, not transfers between other types of tax-deferred accounts. Question 9. Which of the following is a characteristic of an indexed annuity? A. Payouts are directly tied to the performance of an equity index but have caps on returns. B. Payouts are guaranteed and never fluctuate. C. Indexed annuities offer no potential for investment gains. D. They are a form of immediate annuity that starts payments immediately. Answer A. Payouts are directly tied to the performance of an equity index but have caps on returns. Explanation: indexed annuities are linked to a market index, e.g., the S&P 500, but have caps and participation rates that limit the maximum return, ensuring that the annuity holder's return is tied to the market performance, yet with some restrictions. The payouts are not guaranteed to be stable as they depend on the index's performance, but the product offers some protection against market losses. Option B is incorrect because payouts in indexed annuities are not guaranteed to remain the same. They vary based on index performance. Option C is incorrect because indexed annuities do offer potential for investment gains, though they are capped. Option D is incorrect because indexed annuities are typically deferred annuities, meaning they do not start payouts immediately. Question 10. What is the role of an insurance producer when recommending an annuity to a client under Iowa's suitability regulations? A. To ensure that the annuity recommended is in the best interest of the client based on their financial needs. B. To sell the annuity that has the highest commission for the producer. C. To make sure the client is aware of all investment risks even if the product is unsuitable for them. D. To ensure that the annuity is the most complex option offering maximum returns. Answer: A. To ensure that the annuity recommended is in the best interest of the client based on their financial needs. Explanation: under Iowa's suitability regulations, an insurance producer is required to recommend an annuity that aligns with the client's financial needs, risk tolerance, and retirement goals. This ensures that the product is suitable for the client's unique situation and interests, and that the recommendation is made with their best interests in mind. Option B is incorrect because selling a product based solely on commission is a violation of ethical and regulatory standards. Option C is also incorrect because producers are required to recommend products that are suitable, not just to inform clients of risks without regard for suitability. Option D is incorrect as producers are not expected to recommend complex products simply for high returns. Suitability and client needs take precedence. Question 11. Which of the following is a disadvantage of a fixed annuity? A. It offers a variable income based on market performance. B. It does not provide protection against inflation. C. It requires a lump sum payment upfront. D. It can only be purchased by individuals over the age of 65. Answer: B. It does not provide protection against inflation. Explanation: a fixed annuity provides a guaranteed income for the annuitant but does not adjust for inflation, meaning its purchasing power may decrease over time. While fixed annuities offer a stable income, they don't protect against inflation. Option A is incorrect because fixed annuities do not vary with market performance. Option C is incorrect because a fixed annuity may allow for regular payments over time, not just a lump sum. Option D is incorrect because fixed annuities can generally be purchased by individuals of any age, although they are often used for retirement planning. Question 12. Annuities are best suited for individuals who want A. A short-term investment with high liquidity. B. Guaranteed retirement income for life. C. To avoid taxes completely. D. To make speculative investments in the stock market. Answer: B. Guaranteed retirement income for life. Explanation: annuities are designed to provide guaranteed income, typically in retirement, and are best suited for individuals who want guaranteed retirement income for life. B. They offer predictable payments, making them an effective tool for managing long-term financial stability. Option A is incorrect because annuities are generally long-term investments and are less liquid, often with penalties for early withdrawal. Option C is incorrect because annuities do not allow individuals to avoid taxes completely, though they offer tax deferral. Option D is incorrect because annuities are not designed for speculative investments. They are designed for steady, reliable returns. Question 13. Which of the following is a characteristic of a variable annuity? A. The payout is fixed and guaranteed. B. The payout varies based on the performance of investments chosen by the annuitant. C. It provides no tax-deferred growth. D. It is typically used for short-term investments. Answer: B. The payout varies based on the performance of investments chosen by the annuitant. Explanation: a variable annuity B allows the annuitant to invest in various options, such as mutual funds, and the payout depends on the performance of these investments. This means the payout can fluctuate. Option A is incorrect because variable annuities do not offer fixed, guaranteed payouts. Option C is incorrect because variable annuities provide tax-deferred growth. Option D is incorrect because variable annuities are generally long-term investments, especially for retirement planning. Question 14. Which of the following best describes the surrender charge in an annuity contract? A. A fee charged when the annuitant dies. B. A penalty for early withdrawal of funds from the annuity. C. A fee for transferring an annuity between insurance companies. D. A cost for annuity riders like long-term care or inflation protection. Answer: B. A penalty for early withdrawal of funds from the annuity. Explanation: a surrender charge. B is a fee imposed if the annuitant withdraws funds from the annuity before the end of a specified period, often during the first few years of the contract. This penalty is designed to discourage early withdrawals and cover the costs of issuing the annuity. Option A is incorrect because the surrender charge is not linked to the annuitant's death. Option C is incorrect because transferring an annuity typically does not involve surrender charges. Option D is incorrect because surrender charges are not associated with annuity riders. Question 15. Which of the following annuity types offers the highest potential for return, but also the highest level of risk? A. Fixed annuity. B. Variable annuity. C. Immediate annuity. D. Indexed annuity. Answer B. Variable annuity. Explanation: variable annuities B offer the highest potential for return because the annuitant's funds are invested in a range of investments, typically mutual funds, which have the potential to yield higher returns compared to fixed annuities. However, they also come with the highest level of risk because the value of the annuity and the payouts depend on market performance. Option A is incorrect because fixed annuities provide guaranteed payouts with low risk. Option C is incorrect because immediate annuities offer predictable fixed payouts. Option D is incorrect because indexed annuities are tied to a market index but offer some protection against market losses, making them less risky than variable annuities. Question 16. Which of the following is true about a life-only annuity? A. Payments stop when the annuitant dies, regardless of how much they have received. B. Payments continue until a fixed period has passed, even if the annuitant dies. C. Payments are guaranteed for a specified term or for the annuitant's life, whichever is longer. D. Payments are guaranteed for life, but the amount will increase periodically. Answer A. Payments stop when the annuitant dies, regardless of how much they have received. Explanation: a life-only annuity A guarantees payments for the lifetime of the annuitant. Once the annuitant dies, payments stop and no further benefits are provided to beneficiaries. Option B describes a different type of annuity, such as a period certain annuity. Option C refers to a life with period certain annuity, which guarantees payments for both a certain period and the annuitant's life. Option D describes a life annuity with an inflation rider, which guarantees payments but adjusts the amount for inflation. Question 17. In an annuity contract, the accumulation phase refers to A. the period during which the annuitant receives payments, B. the time during which the annuitant deposits premiums into the annuity, C. the period after the annuitant's death, D. the time the annuitant's account balance remains unchanged. Answer B. the time during which the annuitant deposits premiums into the annuity. Explanation: the accumulation phase B is the period during which the annuitant deposits premiums into the annuity, allowing the funds to grow, often on a tax-deferred basis. The distribution phase, not the accumulation phase, is when the annuitant starts receiving payouts. Option A refers to the distribution phase. Option C refers to the period after the annuitant's death, which is outside the scope of the accumulation phase. Option D is incorrect because the account balance may change during the accumulation phase based on the performance of the underlying investments. Question 18. What is the free look period in an annuity contract? A. A period during which the annuitant can cancel the annuity without penalty. B. A period in which the annuitant can exchange the annuity for a different type of annuity. C. The time when the annuitant can adjust the premium payments. D. A grace period before the annuity's payout begins. Answer A. A period during which the annuitant can cancel the annuity without penalty. Explanation: the free look period A is a specified time frame, typically 10 to 30 days, during which the annuitant can review the annuity contract and cancel it without incurring any penalties or surrender charges. This allows the annuitant to change their mind if they feel the product is not suitable. Option B describes a 1035 exchange, not the free look period. Option C is incorrect because premium adjustments are generally not a feature of the free look period. Option D is incorrect because the free look period is related to cancellation, not the payout schedule. Question 19. A qualified annuity is typically used to fund A. A non-retirement investment plan, B. A tax-deferred retirement account like an IRA, C. Short-term personal savings goals, D. A permanent life insurance policy. Answer B. A tax-deferred retirement account like an IRA. Explanation: a qualified annuity B is purchased using funds from a tax-advantaged account such as an IRA, 401k, or other retirement plan. These annuities benefit from tax-deferred growth, meaning the annuitant does not pay taxes on the contributions or earnings until withdrawal. Option A is incorrect because qualified annuities are used for retirement savings, not non-retirement plans. Option C is incorrect because qualified annuities are typically long-term investments for retirement. Option D is incorrect because a permanent life insurance policy is a separate financial product and is not related to annuities. Question 20. Which of the following is an example of a rider that can be added to an annuity contract? A. Inflation protection. B. Life insurance, death benefit. C. Medical expense coverage. D. Disability income protection. Answer A. Inflation protection. Explanation. Riders can be added to an annuity contract to customize its features. One common rider is inflation protection, which increases the annuity payments over time to keep up with inflation. This is typically added to annuities to ensure that the purchasing power of the payouts remains consistent. Option B refers to life insurance products, not annuities. Option C and D are also features of other insurance products, such as health or disability insurance, not annuity riders. Question 21. A period certain annuity guarantees payments for A. the lifetime of the annuitant, B. a fixed period, such as 10, 20, or 30 years, C. as long as the annuitant remains alive, but no longer than 10 years, D. a fixed number of years, followed by a decrease in payments. Answer B. a fixed period such as 10, 20, or 30 years. Explanation. A period certain annuity B guarantees a fixed series of payments over a specific period such as 10, 20, or 30 years. This means that the payments will continue for the chosen time even if the annuitant dies before the period ends. Option A is incorrect because a lifetime payout is characteristic of a life annuity. Option C is incorrect because it limits the term of payments to a specific number of years and guarantees the full term regardless of life expectancy. Option D is incorrect because a period certain annuity does not involve decreasing payments. Question 22. Which of the following is a primary advantage of an annuity with a death benefit rider? A. The annuity provides lifetime income for the annuitant and their beneficiaries. B. The annuitant can receive higher payments if they have a terminal illness. C. The beneficiary receives a lump sum or continued payments upon the annuitant's death. D. The annuity guarantees fixed payments that increase with inflation. Answer C. The beneficiary receives a lump sum or continued payments upon the annuitant's death. Explanation. A death benefit rider C ensures that upon the annuitant's death, the beneficiary will receive either a lump sum or continued annuity payments depending on the terms of the contract. This feature provides added financial security for the annuitant's family. Option A describes the general function of a life annuity but does not specifically refer to the death benefit. Option B is incorrect because a death benefit rider does not relate to terminal illness benefits. Option D describes a feature that could be related to an inflation rider, not a death benefit rider. Question 23. Which of the following types of annuities is best suited for someone who wants to begin receiving income immediately after making a lump sum payment? A. Immediate annuity. B. Deferred annuity. C. Fixed annuity. D. Variable annuity. Answer A. Immediate annuity. Explanation. An immediate annuity begins payments right away, typically within a month after lump sum payment is made. This is ideal for individuals who want to begin receiving income as soon as possible. Option B is incorrect because a deferred annuity delays income payments until a future date. Options C and D refer to types of annuities that may or may not start payments immediately depending on whether they are fixed or variable. Question 24. Which of the following is the primary purpose of a longevity rider added to an annuity? A. To provide a higher income in case of a longer than expected life. B. To guarantee payments for a fixed period regardless of life expectancy. C. To offer tax-free income after a certain number of years. D. To protect the annuitant from market volatility. Answer A. To provide a higher income in case of a longer than expected life. Explanation. A longevity rider is designed to increase the annuity's payouts if the annuitant lives longer than expected. This rider helps ensure that the annuitant's income continues to grow as they age, providing financial security if they outlive their life expectancy. Option B describes a period certain annuity, not a longevity rider. Option C is incorrect because tax-free income is not the primary purpose of a longevity rider. Option D describes a feature of a market protection rider, not a longevity rider. Question 25. Which of the following is the key characteristic of an indexed annuity? A. The payout is directly tied to a market index, such as the S&P 500. B. The payout is fixed and guaranteed by the insurance company. C. The annuity allows for withdrawals at any time without penalty. D. The annuity grows based on the performance of a pool of mutual funds. Answer A. The payout is directly tied to a market index, such as the S&P 500. Explanation: an indexed annuity ties the payout to the performance of a market index, such as the S&P 500, though it may offer a cap or floor on the returns to provide protection against losses. This type of annuity offers the potential for higher returns than a fixed annuity, but also includes some protection from market downturns. Option B refers to fixed annuities, which provide guaranteed payouts. Option C is incorrect because indexed annuities usually impose penalties or restrictions on early withdrawals. Option D describes a variable annuity, not an indexed annuity. Question 26. An annuity that provides a predetermined income for a fixed number of years is known as A. Life annuity, B. Period certain annuity, C. Variable annuity, D. Immediate annuity. Answer: B. Period certain annuity. Explanation: a period certain annuity, B, guarantees payments for a set number of years, regardless of the annuitant's life. If the annuitant dies before the period ends, the remaining payments are made to a beneficiary. Option A refers to a life annuity, which provides income for the lifetime of the annuitant. Option C refers to a variable annuity, which has payouts based on investment performance. Option D refers to an immediate annuity, which starts payments soon after the initial investment. Question 27. Which of the following best describes a fixed index annuity? A. An annuity with fixed interest rates regardless of market performance. B. An annuity where returns are based on the performance of a stock market index, but with a guaranteed minimum return. C. An annuity that only offers income after the annuitant's death. D. An annuity where the income payout is based on the performance of mutual funds. Answer: B. An annuity where returns are based on the performance of a stock market index, but with a guaranteed minimum return. Explanation: a fixed index annuity, B, offers returns that are linked to the performance of a stock market index, such as the S&P 500, however, it provides a minimum return to protect against market downturns. This type of annuity balances the potential for higher returns with a safeguard against losses. Option A is incorrect because a fixed interest rate annuity does not depend on market performance. Option C describes a life insurance product, not an annuity. Option D describes a variable annuity, not a fixed index annuity. Question 20. Which of the following is a disadvantage of a variable annuity? A. The annuity payments are fixed and guaranteed. B. The annuitant has no control over the investment choices. C. The annuity's value fluctuates with the market performance. D. The annuity is subject to taxes on interest earned only. Answer: C. The annuity's value fluctuates with the market performance. Explanation: a variable annuity, C, allows the annuitant to invest in a range of options, such as mutual funds, and the value of the annuity is tied to the performance of those investments. This means the value and payout can fluctuate with market performance, which can be a risk. Option A is incorrect because variable annuities do not guarantee fixed payments, so that payouts are based on investment performance. Option B is incorrect because the annuitant usually has control over investment choices. Option D is incorrect because variable annuities are taxed on the total earnings, not just interest. Question 29. What is the primary benefit of a guaranteed lifetime withdrawal benefit? Either A, it guarantees that the annuitant can withdraw a certain amount of income for life, regardless of market performance. B, it allows the annuitant to withdraw all funds without penalty after a specified number of years. C, it provides a lump sum payment to the beneficiary after the annuitant's death. D, it guarantees that the annuitant will receive the full value of the initial premium investment. Answer: A, it guarantees that the annuitant can withdraw a certain amount of income for life, regardless of market performance. Explanation: the GLWB rider A ensures that the annuitant can withdraw a set percentage of their annuity's value for life, even if the market performance causes the annuity's value to decline. This guarantees a consistent income stream, regardless of market conditions. Option B is incorrect because a GLWB rider does not offer penalty-free withdrawals for all funds. It is limited to specific withdrawal amounts. Option C refers to a death benefit rider, not a GLWB. Option D is incorrect because the GLWB guarantees income but not the full return of the initial investment. Question 30. Which of the following would make a qualified annuity tax advantaged? A. The annuity is purchased using after-tax dollars. B. The annuity is purchased with pre-tax dollars through an employer-sponsored retirement plan. C. The annuity offers guaranteed interest rates regardless of market conditions. D. The annuity is linked to a stock market index. Answer B. The annuity is purchased with pre-tax dollars through an employer-sponsored retirement plan. Explanation: a qualified annuity B is purchased using pre-tax dollars, typically through an employer-sponsored retirement plan like a 401k or an IRA. This allows the annuity to grow tax-deferred until withdrawals are made in retirement. Option A describes a non-qualified annuity which is purchased with after-tax dollars. Option C refers to a fixed annuity, but this feature does not necessarily make the annuity tax advantaged. Option D refers to a variable or indexed annuity, which does not directly impact the tax treatment of the annuity.